Thank you, everyone, for coming out today. I've got an amazing panel here of some of the top folks in the lending space who understand everything about lending and borrowing, yield, and also what went wrong with the other companies. That's why they're on stage and the other ones aren't. So to start us off, though, I want to touch on something that a lot of Bitcoiners get hung up on, where they think that lending and borrowing using Bitcoin is impossible. On a Bitcoin standard, lending and borrowing wouldn't exist. And to answer that question, if it should exist at all, I'm going to hand it over to Mauricio to cover that.
Yeah, thanks, Dan. So lending is a topic that has thrived. The Bitcoin lending markets have, of course, exploded over the last few years, and there's a very good reason for that. And lending, historically speaking, is a natural activity for humans. We've been doing them since back in the Mesopotamians. There were loans issued in silver, issued in seeds that got repaid with interest. And so it's been an activity that's been going on forever across all asset classes, across all of humanity. And today, what we have is just a much better asset in Bitcoin. And because it is so much superior to other assets out there, it is only natural that it's going to have a thriving lending industry around it. And there is a responsible way of doing lending, as the group standing here can demonstrate. And I think that's what we're about. It's an activity that has to happen, it's going to happen. History has shown us it's unstoppable. We can't really stop humans from borrowing and lending with each other. And we just want to do it responsibly with the best asset we think there is.
I love that answer. And I think, yes, lending and borrowing is an inherent human activity that will always exist. There will always be demand, a time preference demand to have money now and paying someone back later to utilize that that preference. And, second question I have here is, I want to hand this over to Alex. Alex, with BlockFi, and then you can cover some other companies as well. With BlockFi, was this negligence, just a business mistake, or something more insidious?
I think not just BlockFi, but at several of these lenders, there were egregious lacks of risk management. Risk management not actually even being done, not only being bad at it. In fact, I would go so far as to say at some of these shops, perhaps bordering on criminal negligence, you absolutely can manage asset liability matching. You can manage maturity and duration risk. It is not a foregone conclusion that a lending book is going to blow up, right? In fact, that rarely happens if adults are managing risk. But if we look across the space, what do we see? We see BlockFi, dead. Celsius, dead. Genesis, dead. All of these firms, and we could talk specifics, but I think it's, if you just read crypto news, you know a lot of them, egregiously used like customer deposits in ways that were not supposed to be used.
Like, give us an example of, so they're using customer deposits and they're not just lending it out. What were they doing with it?
Yeah, I mean, in some cases they were operating like hedge funds. They were investing the deposits. They were doing stuff on chain, right? Celsius, pretty famous, came out in their bankruptcy. They had given like $1 billion to a DeFi trader to just trade in DeFi, right? That isn't lending, right? That's not managing a lending book. That's running a hedge fund. And that isn't what most of them told their clients they were going to be doing. But it is what we do in lending is you have over-collateralized loans, you have creditworthy counterparties, you manage the assets directly. It's like having a short locate in equities. You know exactly the asset you owe the borrower, and you know how to get it, and you have the funds to get it, or you hold it, right? You don't like, ooh, maybe there's a pile of money. If we need it, we'll go find something to pay them out. And that's what some of these companies did. It's just they were not adults in the room.
And yeah, go ahead, Jason.
Yeah, I would just add to that. I think, people thought they had some level of diversification. And I say people, I'm talking about the lending platforms. And, maybe they did, but, taking the extreme, like it's public what Voyager's, the concentration of their lending book was north of 40% in multiple instances, not just the day they filed for bankruptcy. If you go back even several quarters, they were heavily concentrated. But it's not just to one borrower. It's also you have to look at the correlation amongst those borrowers and across the entire crypto ecosystem, which we all know is highly correlated. So if you're going to lend across a highly correlated ecosystem, you have to be mindful about those correlations. And, I remember something SBF said shortly after FTX filed when he was doing his mea culpa. He said, well, this was like a 2 standard deviation event. And I'm like, yeah, but you got like 3 or 4 years worth of history, and that's just not enough of a data set to really assess what a 2 standard deviation event really is. Like if I said what's a 2 standard deviation event for a week's time period, it's not that relevant. And intuitively, people knew or should have known these correlations were high and managed their risk appropriately.
And Jason, you've looked deeper into Celsius than some other folks have. What were some other things that you discovered digging into Celsius and their loan book and everything that they did?
Yeah, we're very involved in the Celsius process. We spent a lot of time on their balance sheet and what they had done. And most of this is, well, pretty much all of this is in public domain. To Alex's point, there was a lot of, I would say, more kind of venture capital, private equity type investing within the portfolio, but that was being done against the demand deposit base, essentially. So think about, banks have arms that may, do VC, PE, or longer-term lending, but they don't really do that using pure deposits. And here, it was essentially a deposit base that could, be withdrawn in a day, in a minute. And they had a bunch of assets that were completely illiquid. So, too much concentration, too much correlation, and a complete lack of liquidity management was pretty consistent across a lot of these platforms.
And I would add, I think one of the things that's also a common trait, and if you look at, for example, the BlockFi and the Genesis examples, they are largely concentration issues. BlockFi was heavily concentrated at the 3 arrows. So was Genesis, really. But if you look at Voyager and Celsius, you find a lot of games with their tokens. And I think the token scheme that a lot of these firms try to implement inevitably ends up in them trying to do financial trickery, and that just leads to bad outcomes. And so I don't think it's shocking that out of the people that are left, very few of them have a token, and even the people that got into issues, more of them had tokens than not, I guess.
I'm going to throw a counterpoint out. What's the difference between these lending platforms having a token and using that to subsidize their yield versus venture capital dollars?
Well, you can't really pump your venture dollars as easy as...
That's true. You can't print the venture dollars out of thin air, I guess. Well, I mean, the Fed can, but,
I think, it should have been a bit of a red flag when you were using your own created token to enhance yield. I also think, hindsight obviously 2020, but when you determined your yield based upon beating your competitors, so how do you, I need my yield to be more than Voyager's or BlockFi, but it has nothing to do with the yield I'm actually earning on the assets that I've invested in.
Yeah.
So these are just sort of very obvious problems. And I think, with greater disclosure, remember all these companies were also private and had no disclosure whatsoever. So if you could have seen what the revenue base was, what they were earning on their assets, it would have been very transparent that that's not sustainable. It's Ponzi-esque.
There were also some, Mauricio, you mentioned the concentration, BlockFi's concentration at 3AC. 3AC was an equity investor in BlockFi. So there was some very clear, intertwining that it's hard to imagine that equity ownership stake did not influence how BlockFi handled their loans, right? And that's also needs to be disclosed. It's an intertwining that's incredibly dangerous. Jason, you're talking about the correlations across parties in the industry like that. I mean, and of course, we also know what 3AC, one of the big trades they were doing was this GBDC ARB, which brings in Genesis also. And these guys, all three of these firms in particular, were heavily intertwined and concentrated and just didn't actually run a normal lending book. It's not that hard. It's not rocket science.
I think Genesis was the most disappointing one because they were supposed to be the smartest guys in the room. They were one of the oldest desks. Supposedly had the best risk management out there, but what we saw is they were just like everyone else. There was nothing special about them.
I mean, we don't know their actual P&L. They're not a publicly traded company, but we did some you remember they used to put out a monthly or a quarterly report for years showing their lending volumes, and we did some back of the napkin math on knowing what our rates were, what we thought their rates were, how much revenue is this company making, and it's their claim against 3AC and the 3AC bankruptcy is more than they've ever made. That's how big their exposure was to one client. It's unbelievable to even think about that.
No, it's insane. And I want to go back to the point you made about pricing your yield based on competition rather than on the market, because I remember distinctly having several conversations with our clients in the run-up of 2021 who were coming to me saying, Mao, why isn't Len offering 12% on USDC? And I said, because we lend the dollars at 10.9, that's why I can pay you 9. I can show you exactly where my 9s come from. And they're saying, but I'm getting 12 at Celsius. I'm like, do you know how they're getting the 12? Have you asked them how they're getting the 12? Most people didn't. Most people just went with the yield, and that fueled this idea that you had to price your yield based on the highest in the market because people were not doing any sort of diligence. And unfortunately, we had to come to this to now people are over-indexed to the diligence side, which is a great thing, but unfortunately, it's a little too late for some because to your point about diversification, a lot of our clients diversified across different platforms, and they ended up only getting left what they had at Latin. And so there's almost like a general disappointment on the other platforms, and there was also a lot of misrepresentation. Some firms, I won't name the name, but some people even said that their stablecoin accounts were FCIC insured. And
I remember that. Yeah, that was insane. Yeah, it was a lie.
Fraud.
Yeah, fraud.
Yeah, I think, I ran hedge funds for a lot of years and still do. If it was so easy to raise money that you could basically do anything that you wanted with it, just by putting up a website, that's what everybody would do. And last I checked, you have to go through a lot of regulatory hurdles. You have to draft very voluminous legal documents and have a lot of disclosure with respect to what you're going to do with somebody else's capital as a fiduciary. And, I just think, a lot of these things were just obviously lacking. And that should have been, these were all knowable issues that both regulators and investors should have been thinking about.
Yeah, there's plenty of frameworks for raising capital and doing things with it, whether it's venture or lending it, right? That's totally something you can do if you are some kind of fund, a hedge fund, right? Maybe you're a registered investment advisor, whatever you are, right? That's not what these platforms marketed themselves as. But then they went and did that, right? I mean, if right now I say I want to invest in a fund, let's say Dan starts a fund, right? And I'm like, okay, there's risk of loss because he's an asset manager, and if he doesn't do amazing, I could lose money. You know this as an investment, right? If that's all that happened, it'd be like, well, they lost some money. Like, that's too bad. That happens, though. But if they're marketing themselves as like, deposits are guaranteed or anything like that, and of course, a lot of them had some fine print saying like it's not actually we own everything. But like most of their users really thought that they were just getting organic market-based yield in a safe way. They didn't know that they were going to have their money put in DeFi, that they were going to buy a mining business, that they're going to, you see the bankruptcies like in some of the number of assets these companies have on their balance sheet, like illiquid privates. It's crazy.
Yeah, that's why when we first started looking at Celsius, we thought it was actually ripe to reorganize as opposed to liquidate, because liquidating these illiquid assets would be very challenging and take a long period of time. And these are operating businesses. So, from our perspective, to kind of, have the phoenix rise out of the ashes, that's a distinct possibility, but it's because of the nature of the investments that were made in the first place. Had the investments had the liquidity that they should have had, they'd all be monetized, and this bankruptcy would have been over, 8 months ago or 9 months ago.
In the last part of this conversation, I want us to dig into how do we improve the industry. You guys are the survivors. You had prudent risk management, and that's why you're on the stage today. What steps can we take as an industry to help improve what are the steps that we can take as an industry to make this a little bit better, for retail institutions, and just have a better level of honesty and transparency?
I'm happy to take a crack at that one. To tell you what we're doing on the Let-In side. So people just want to know where they're, what are you doing with their assets? How are they generating the yield? Like, people are actually very intelligent. They can understand if you explain what it is, the activity that you're doing to generate the yield. They would like to know what it is that you're doing with the money that gets them the yield. So you need to be as transparent as you possibly can. And I think that's the only way out of this is transparency, accountability, and education. for us, we've been doing proof of reserves since before it was cool. We started doing proof of reserves back in 2020.
It was like you guys and Kraken. I think
Yeah.
we're like the only two.
We were the only lending company we were the first. You guys were one of the first exchanges. We were the first lending company to do it, and back then nobody thought that was, pioneer or people were the ones that do their diligence and understand the business were very appreciative, and we got a lot of business out of it. But by and large, that was in the run-up when things were going vertical. Most clients were asking about things like Dogecoin and Shiba Inu, and proof of reserves was sort of a second priority. But we did it anyway because our view was that proof of reserves is a very difficult thing to do for a lending company. It's a complex exercise. You have to have a snapshot in time of all of your assets, all your liabilities. They all have to match. And if you don't put that in the DNA of your company from day one as you build your products, it becomes very difficult to retroactively put proof of reserves when you have 100 assets and 100 products. So we did this from very early on. We continue to do this. The next thing we do is we publish this thing called the Open Book Report, where we give a breakdown of all of our assets in a pie chart. So where's our USDC at, custody, lent, banks? Where's the Bitcoin at, custody, lent, banks? And that's going to be produced on a monthly basis and ideally in real time for our clients to see it on their dashboard. And then the other one is we just got our regulatory approval at Cayman Islands. I believe we're the first lending company to ever get that, so we're very happy. And that's I believe, a very robust framework that's going to protect and lead by example for other jurisdictions that want to do similar things. So.
Yeah, I would just pick up on that a little bit. I mean, maybe go back to the very first question. I do think there is and will continue to be significant demand for BTC-backed loans because and so you kind of have to believe that to want to build a lending platform in the first place. And I believe that because, I think most people here want to be long Bitcoin and short fiat, and this is actually a very effective way to do that. But then if that's the cornerstone of the business on which you're building, to Mauricio's point, it needs to really be built with significant transparency. I think you also have to recognize the limits with which you can scale a business, because what happened with a lot of these businesses that failed, they also were growing so rapidly, which, it's one thing to build a tech company where, whatever, I'm starting Allbirds, okay? It grows like crazy. Worst thing that happens, my shoe blows out and maybe somebody twists their ankle. Here, you're taking people's, capital, but they've worked for, decades. And you're a fiduciary, and you need to trust it that way. And if you can't grow, you can't outstrip the risk management, the systems, and actually the human capital you need within your business to prudently manage that risk. And I think that's just, maybe a limitation. You might not get as high a VC valuation, et cetera, but that's the right way to build a sustainable business over time.
I totally agree with what both of you guys have said. I would say, look, Galaxy is a publicly traded company. So that comes with a lot of transparency. You can see our quarterly financials every quarter, right? Which we publicly publish because that's what public companies do. So I agree, though, transparency is a huge important thing here. You have to know who you're lending and borrowing to and from. You have to know that they actually are running a lending book and not some other weird thing. That they actually know how to manage risk, not just take risk. And I love all the stuff about proof of reserves. I mean, any additional transparency you can give is needed. But look, at the core, it's just actually be good at risk management. And I don't know how we make sure that the masses can distinguish between a Celsius and a lead-in, or a Celsius and a Galaxy, right? But by being here and not blowing up, I think that's a pretty good start.
It's funny. I think that people look at firms like Wells Fargo and JP Morgan and such, and they're big, but they're big because they've stood the test of time. Like these are firms that have hundreds. Their histories are like generations, and so it's not a get big quick business. You have to demonstrate that you can do this responsibly, and that's how you accrue business. But otherwise, it won't work.
And do you think this will be industry-led, like an industry-led standard of transparency and accountability, or do you think it's going to be a regulatory-led?
I think it's going to be both. I think it's going to be both. I think some businesses are going to do that proactively, and I think some regulators are ultimately going to come in and say, this is what's required if you want to service this particular jurisdiction. So
I completely agree with that, but I think, I actually think it should be industry-led because I think regulation is going to be slow to develop regardless. And I think if the industry leads it, it's actually going to make the regulation, fit better. And so the industry really does need to lead. And people need to be a little bit sober. If something seems too good to be true, it probably is. And if you don't have the requisite transparency that you need, then you should not put money on a platform or invest capital.
Yeah, I think it's hard to imagine in this environment. I mean, these blow-ups, not just the lenders we've talked about, but FTX too, they have really sullied crypto's name in governments around the world, certainly in the United States. So there's just almost certainly going to be some regulation involved, but I think the industry already kind of is starting to lead on this, right? I mean, that's what we're here trying to do right now, is explain that there are adults in the room at these companies, and it can be done. It's like I said at the beginning, it's not a foregone conclusion that like lending books don't just like miraculously blow up and lose more money than they've ever earned in revenue. That doesn't just normally happen, right? Something very bad is happening if that happens to your company. But I do, so I think I want to mix, but I look at this regulatory picture. This is not a regulation panel, but I follow the regulatory landscape in the U.S. and Canada and Europe very closely. I don't think anything's going to get done in the U.S. this year, really, certainly not in Congress, but it's hard to imagine lending doesn't come out somehow in a regulatory framework.
And we've only got a few minutes left. I want you all to give your last final thoughts for the audience on the lending and borrowing markets. Jason, do you want to go first?
I'm sorry, I actually couldn't hear you.
The kind of any final thoughts that you'd like to give the audience or anyone watching this on just how to approach this space, or any last words of wisdom you have?
Sure. Look, I do believe this is an asset class that actually lends itself, no pun intended, very well to lending, because as some of the points Mauricio was making originally, it's a bearer asset. It's easily. For example, like you can write a smart contract, you can foreclose, you can put metrics around it. People have spent decades setting up, kind of like bankruptcy remote lending type transactions. That's the whole securitization market in TradFi, whereas crypto lends itself much more naturally to that type of a borrower universe. So I actually think it's really a great place to do lending. It just needs to be done in a very transparent and compliant way.
Thank you. With those final thoughts, Alex, and then Mauricio.
Yeah, I would just say we're still here because we didn't do those crazy things. And yeah, we experienced the same thing you talked about, Mauricio, with some clients being like, wait a sec, why? Like, we're losing clients to some venture-backed lending startup, right? Or we're losing lending deals. And we're like, we find out and we're like, they're giving away free money. That's what's happening. Right? We didn't do that. That's why we're still here at Galaxy. And I think there are adults in the room still. The capital markets and crypto have contracted, right? And there's less liquidity, post FTX and all this stuff, but it still is there. We're still here.
I guess my last comment would be I firmly believe that borrowing against your Bitcoin will be more accessible, cheaper, faster, and better than borrowing against real estate in the U.S. I think it can be done faster. Transaction fees are lower. It can be foreclosed much faster. It just makes sense. And so because it's a globally accessible asset, this will be the first time people all over the world can access dollar liquidity at the same rates, because we lend against the same asset. We get to treat everyone the same, whether you're in Colombia, Canada, the U.S., you pay the same rate, you get the same treatment. And that, to me, is a complete game changer. This isn't going away, and we want to lead this industry, and we want to build that future.
Awesome. I love those final words. Thank you, guys. Thanks to the audience. Appreciate y'all coming up.
Bitcoiners, welcome back to Bitcoin 2023. This is the Bitcoin Magazine live desk hosted by Marathon. I am joined by my esteemed panelists, Samson Mao, CEO of Jan3, Preston Pish, the co-founder of the Investors Podcast Network, and Michael Saylor, the chairman of the board of MicroStrategy. We just heard a great conversation of what happened to the credit and lending markets. Mauricio, the CEO of Ledden, mentioned we cannot stop humans from lending and borrowing. Samson, I'm tossing it to you. You had some choice words for some of the words that the panel else for talking about it. Their most recent thing.
Well, I think it's interesting. We're listening to the survivors of the lending crisis, and we still don't really know, like, are they safe, right? And I would say we need better solutions than just bucketization of money into one big pool where they deal with lending. And I think there are technologies out there like peer-to-peer systems. Hodl Hodl has one where you're actually lending with another peer. But they say they're safe. But personally, I wouldn't give my money to Galaxy. I love Alex, but I wouldn't put my money anywhere near Mike Novogratz.
All right, fair enough. We've seen BlockFi, Celsius, and Genesis collapse. Preston, going to you. Do you trust any organizations, or is it don't trust, verify, and keep the Bitcoin yourself? Or is the lending and borrowing market something that needs to be built out for the Bitcoin network to grow and propagate through the world?
I don't think that you need borrowing and lending for Bitcoin to do what it's going to do. I think the legacy financial system is going to do all that heavy lifting for us. When I think about borrowing and lending, personally, I'm looking at my Bitcoin and my expectation on what I think that's going to do as an annualized growth over longer periods of time. A 4-year period is what I like to kind of measure the performance by. I don't need an additional, couple percent on top of what I already think it's going to perform at personally. So, maybe it's just my personality more expressing my opinion on this market and whether it's actually needed, at least at this point in time. Maybe 10 years from now I might have a different opinion, but today it's just not something that really I find that fascinating or important to the overall ecosystem.
Michael, tossing it to you. So I know institutions are normally in the borrowing and lending markets. Can we see an institutional MicroStrategy lending desk or lending platform?
Well, MicroStrategy is not going to be in the business of lending, but MicroStrategy holds a bunch of Bitcoin on its balance sheet, and so if you were to buy MicroStrategy stock backed by the Bitcoin, you could then pledge that as collateral on a big, with your broker-dealer like a big bank like Morgan Stanley or JP Morgan, and that might be a way for you to get at certain liquidity against Bitcoin as collateral.
All right. Thank you so much. Remember to smash the like button and hit the subscribe button. We're going to go back to the Nakamoto stage for what happened to DCG. We'll be back shortly.